con los terroristas.
Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend Podcast. Today is Friday, March 6, 2026. S&P 500 currently sitting at 67.56. I'm David Zarling. I'm here with Honey-Do List McMillan. Ian, you got some things on your project for the spring coming up? Or maybe you're already working on them.
Yeah. I don't know if I'd call it a honey-do. I mean, I make my own lists.
Oh, see, that's a good point. Forgive me.
I make my own lists. I'm excited to do projects.
Yeah, Ian.
Get out.
Ian's do list.
Yeah.
No, it's good. I
have
wish
a honey don't list.
Honey don't list?
Yes, that's long. That's very long. Continuously being added to.
I might use that. Honey, write down some things maybe I shouldn't be doing. I feel like if you could build a retaining wall for this market, that would be good.
Need something. I mean, I was over it a few weeks ago.
I mean,
Just
this is
kind of
the
dripping, and then we bounce, right? I mean, these downtrends, short-term or long-term, downtrends are such a pain.
Well, and sideways is also a pain. And
yeah, but you get the gap, then they bounce it, and then gap it down the next day.
Yeah, you're talking about chop, and I think that's where people get hurt pretty quick if they're a near-term trader. And this is the lowest level we've recorded at since November. Now, to be fair, I'm talking about 100 points on S&P 500 as an example. But the same characteristics that we've discussed before remain intact, which high split market, dispersion, big differentiation between the best performing sector and the worst performing sector. And I got to ask you, what do you think about the worst performing sector year to date?
What is it?
Financials.
It's unfortunate. Doing worse than real estate? Come on. Doing worse than Staples? Staples got hit yesterday. See, that's another thing. Things getting weird. You don't want to see Staples perform near the downside.
Right. Well, and it's not that financials have to be the best performing sector, but when they're down 8% year to date.
We lost JP Morgan, man.
Lost it? Where'd it go?
Below 200 day.
Below a 200 day.
You get delisted when you go below a 200 day.
In some strategies, yes. Maybe that's an appropriate time for me to highlight the sponsor of this podcast, the Adaptive Select ETF listed on the New York Stock Exchange under ticker ADPV, which helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend, and since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. I think you made a good point there about JP Morgan, below a 200-day.
Bank of America. Hey, sorry, Dad. You said European financials.
Yeah, some of the leaders there that had been.
Look at Deutsche Bank. Terrible.
Yeah. So there's a little bit of problem there. A couple of these below their 200 days, and Paul Tudor Jones was often quoted, and I don't think he was wrong, that nothing good happens below a 200-day. And again, it doesn't have to be that financials outperform on a relative basis or that they're the leading sector. just want them to participate, and they are not participating. A little bit problematic. And we've talked ad nauseum to our clients that 6,800 on the S&P 500 is an important level. That's a level we've held many times in the past, and we are currently below it. Now we're recording this 10:30 Central on a Friday, 11:30 Eastern. I'm not going to go through all the time zones, but we're right there. We're right on the edge of the horrible in between. Some things in downtrends, some things in uptrends, broad market speaking, trendless for 6 months at least. And some of the areas that had been holding up really well took it on the chin this week. Whether you're talking about emerging markets.
Yeah. What
Or-
was that, dude?
Well,
The strong dollar is throwing everything off.
Well, I know we've talked about South Korea a fair amount, and I think that possibly the thing that was lost in that conversation and a point that you were making is it had left the station really hard to get involved in. And here we have a pretty aggressive counter trend move in South Korea.
Is it back at the station?
I don't know. That's a great question.
Are we buying South Korea yet? Are you buying Samsung yet?
Samsung.
What do you think about oil?
Oil. I mean, it's going to fit everybody's wannabe narrative, right? With Iran and the Strait of Hormuz. Pretty big week.
$90 a barrel.
Yeah. And some rumorings of, I don't know who would be in charge of this, the administration stepping in and buying, trying to impact price with futures. I don't really know how that works with a commodity that's consumed and when supply is cut from the Strait of Hormuz. I don't know. Definitely a large move in oil using crude futures. I mean, this is the largest 1 week rate of change since the COVID correction in oil.
Trump's going to give us negative $40 oil and $200 oil. Amazing.
Yeah, a lot of volatility there. And energy is the top performing sector.
Yes, very strong. Although I think it'll be if they start selling energy stocks, even with oil holding up, I think that could be a sign, another risk off sign. We'll see if that happens. It hasn't quite happened yet.
No.
Not having the day you would expect. If I told you crude was up 9%, 10%, and I told you XLE was flat.
Yeah, I wouldn't have guessed that.
So yeah, little divergence here. XLE peaked on Monday. You've had crude continue to go up quite a bit since then. So yeah, it'll be interesting to see what they do. Aerospace got hit yesterday.
Holding up okay.
Still at a pretty strong uptrend. Hard to hate on it long term.
What do you think about these characteristics? So you've got massive retail flows in, so a lot of retail buying. You have bearish sentiment on surveys and exposure surveys. Now we know that what you do versus how you answer a survey can be very different. You've got a VIX at 25, massive put buying. Now some are highlighting that the put buying is happening in such a way that it's not necessarily on the curve of hedging that matters in the near term. It's more long term.
Okay.
So you have this negative sentiment by institution, large put buying, so that's future buyers. But you also have huge shorting of the VIX or volatility and retail flowing in. Kind of matches all the chop we've been seeing.
Yeah. A lot of different things to think about there.
And we've talked to our clients about the 6,800 level. Like on S&P 500 might be a good place to take your foot off the gas. We still have a rising 200-day using a broad market instrument like the S&P. What are some other levels that you're looking at, Ian, that might provide some levels of interest on who has control of the market?
Yeah, for sure. 6,800. I think that has been tapped on many times.
Talk about that from a technical perspective. What do you mean by that? So 6,800 has been tapped on from a price perspective, how do you think about that from a technician standpoint?
I think it's just clearly an area of interest.
And if it breaks,
Yeah.
is that one of those things where you tap it too many times?
I think it could be just really strong support. I mean, it's obviously there's kind of what's the best way to put this? I don't think that there's like a term or anything other than you've just played the game long enough. But yeah, there can be too many taps, probably not support, eventually breaks. I don't know if there's a set number to that, but yeah, especially something like a large, very liquid index. I think it's certainly, I mean, I don't know how you would look at a price chart and not notice it. And same with NASDAQ. If you look at, I don't know, let's call it 24,600, whatever you want to call that in there.
I think it's a valid point. Technicians study interaction of supply and demand, and they have names for things, and we don't necessarily agree with those names, but some of them might be double top. So you have price touch a level twice on the high side and fail. You might have a triple. Same thing with bottoms, double bottom, triple bottom. And I guess my point is, you can have triple bottoms or triple tops. And what I mean by that is price touches a level 3 times, and that marks significant resistance. And those can be appropriate knocks or taps, using the term that you're using. But rarely do you see quadruple, quintuple, sextuple.
Yeah, then you're getting more into a lethargic behavior at that point.
That you're really,
and especially, as each bounce gets smaller and smaller, which is what we've seen over the last few weeks, really, I'd say since, really mid-February, we've come down to 6780 multiple times, 6800 multiple times, and each bounce just continues to look a little more pathetic.
Yeah, that's a good point. I mean, we held 6,800 on S&P January 20th, February 5th, February 17th, most recently March 3rd, and now we're below that level. So there's 4 levels, and I don't want to come across as hard rules, because by the end of the day, we could be back above 6,800, and maybe that was it. But now, was that all basically chewing through demand? And now the 200 days sits at 65.80, and the lows from late last year sit at 65.40. And so you're on the cusp of a breakdown, what we would describe a breakdown here using technical terms, meaning that there's enough supply in the market to drive prices lower. And it's not going to be pretty if that's the case, but also perfectly normal. There's nothing necessarily pretty about markets.
Well, you'd be below a 200-day.
Right.
Be below a 200-day. Yeah, if you're below 55, what'd you say, 65.80, 65.20?
Yeah.
65.20.
And that would only be a 6% correction from the highs. And what's interesting, another truism, I don't want to call it law. There's no such thing as law in markets other than supply and demand is economic law. You could have that 6% correction, perfectly normal, rebound from there, still not fix anything. And where I'm going with the truism is tops are a process.
Yeah.
Bottoms are an event. I'm not calling for a top. That's not what I'm saying.
I mean, this is starting to feel more process-ish, though.
Right. I think that's absolutely fair. And you look at the big names, like, let's just use Apple as an example. Apple on a relative basis. If you were to pull up a chart of Apple versus S&P going back years and look at August of 2020 through now, is that a process? Is this a consolidation in an ongoing uptrend, or is this a topping process? To be determined. I wish I
Do you
could
see
answer.
anything? What's the best way to ask this? Do you see anything that tells you it's not at least like an intermediate term top? Like, is there anything where do you see anything where you're like, yeah, like I think we just gotta. This is just a pain in the butt sideways move. Just gonna have to wait it out.
Yeah, I think.
But we're going higher.
Yeah, I think if that thesis, to confirm that thesis of this is consolidation within a move higher, it would be that you have just enormous hedging and put buying going on.
So you think to move higher, we gotta take we gotta squeeze out the shorts.
Yeah, I think when this gets really dangerous, like when things could accelerate to the downside, if there's a downside, if we're breaking below those levels we talked about before, and S&P is breaking its 200-day, or it's breaking 65-70, breaking a 200-day, that in most scenarios, it's when the put buying stops, when that process hurts so many people that you no longer have hedging happening, that there's an issue. Because all put buyers are future buyers of equity. And at the same time, we're perfectly allowed to have a 6% range for a few more months. Not fun. That's trendlessness. That would be by
Are you
all
sure
intents.
we're allowed that? I don't know. I thought they put that in the rule book somewhere. If it's not, I would like to, in the off season, I would like to have us add that to the rule book.
Yeah. And a 6% range, and maybe it's not. Maybe it's because the other thing that's at play here is seasonality, which typically March through summer in a midterm year is a negative seasonality. Could I see the market really struggling through April, breaking down in spring, summer, correcting 12%, 13, 14%, and then rallying through the rest of the year? I could. That is a thesis. But to answer your question, is there anything that is in the thesis for we eventually move higher? It could be if we hold 65, 70, hold a 200-day. We've already had pretty good discounting in the mega names. Like if you had told me the amount of Mag 7 stocks and how far they're down, and the market would only be a few percentage points off the highs, we're sitting 3% off the highs, I wouldn't necessarily have guessed that. And you've got 65, 67% of stocks in the S&P 500 outperforming the S&P 500. I could see that thesis too, that we consolidate through April and then move higher.
Through April, Dave, I'm not waiting another 2 months.
Patience is a virtue, man. How about you? What things are you looking at that either have you raising some red flags, or, hey, this is pretty healthy consolidation and we can move higher from here? Anything that you're looking at that has your attention?
No, I've just moved on to praying.
Praying is always good, whether it's markets or anything else.
I don't know. I mean, yeah, financials, got to figure it out.
Those are problematic.
Microsoft has got to figure it out. I mean, you'd probably like to see Bitcoin stop. I don't know if we need that. It would help, to have some type of risk on, a bigger risk on asset. Moving higher, that's calling it falling. That looked like, 2 days ago, it was going to try to get back above 75,000. Again, a pretty big area. Never made it.
I do think it's telling that all the major U.S. indices, S&P, small caps, NASDAQ, Dow Jones, they're all below their year-to-date volume-weighted average price. And so year-to-date, most are underwater, and that's a little bit problematic.
IWM's kind of lost its rate of trend from the tariff flows.
And you could
go back to 245, which makes me absolutely sick to my stomach.
It seems magnetic at this point. And I think what's interesting is that let's say we have that move where we're 6% off the highs. Imagine the put buying at that point. Like, you think we're at elevated levels now, the narrative would be terrible. The put buying would be even more. Then you would have a pretty aggressive move, whether that move is the start of something new or a counter trend move in a larger bear market. And markets aren't easy. I think it's interesting to note, even in the tape today, the strength out of former leaders like Palantir and AppLovin, software. Those moves, it's really hard to short those things that had been leaders, got discounted pretty hard, to now say, oh, that's where you should be protecting.
Yeah.
You'd be getting yourself things handed to you. And I do, one thing that I do have a little bit of concern, or maybe more than a little bit of concern, is just what we're seeing out of credit, like CCC credit spreads, junk bonds, CLOs, and those are right at a breaking point for some things. You look at junk bonds.
Yeah, Monday was terrible. Kevin was quite upset. I think I heard him sniffling on the market call. And then he went on mute. He said he wasn't crying, but it was a rough day. Monday was a rough day for fixed income. They have not fixed it. Again, similar to equities, kind of tried a pretty lame 1.5 day bounce. And it's a tough look. It's a tough look.
Right. And I would say, like, if we're going to use the sentiment as a gauge, there's plenty of negative headlines out there. And we've got private credit having issues. We've got Iran, budgetary concerns. It's just negative sentiment all around. And so where we are right now, I'll just simply describe it as the hard in between. We've had really great returns in something like the S&P 500. We've had really great returns in emerging markets and international stocks for the most part.
Golly. Everyone's gotten a piece of the pie the last few years.
And now's the hard part. And I think it's always a great reminder to be thankful for trends. There's uptrending markets, there's trendless markets, and there's downtrending markets. And right now, we've been in a lot of trendlessness using U.S. markets, uptrends in international and things like gold miners and gold. And those could be heading into trendlessness. And that's the hard part. That's where a lot of danger exists, is the trendless markets, where there's just a lot of chop. You brought up big gaps. Not surprising, considering VIX sitting at 25, right? We can, general rule of thumb, take the VIX divided by 16, get our daily move, potential daily move. And credit spreads haven't cooled off. We've got some pain in credit markets. It's not an easy market right now. And if anybody tells you otherwise, they might be trying to sell you something. I'm not sure. It's not easy. High dispersion. It's a hard market right now. And what we know is, from hard markets come easy markets. And what most people don't like to talk about is one easy market is downtrends, like a defined downtrend. Uptrends are, those are really nice. But a downtrend is also well defined. We're not there yet.
Yeah, but they behave like such little rascals.
So there's definitely work to do. Definitely work. And to me, the fact that we can't get above the zero, what we call the zero line here at Adaptive, January 1st, technically January 2nd, price levels below year-to-date volume-weighted average price, you still have problems in ratios such as high beta versus low vol, or discretionary versus staples. Still some problems there. So the way I would describe this is, we're in the construction zone. We got brake lights. We've got construction barrels. Makes sense to not have our foot on the gas.
Maybe we should just go home.
Could be. We're trying to get home, but we're stuck in this traffic.
Could pull over.
Yeah, caution is warranted. If this is a tops are a process. They take a while, months. If this is consolidation, that also can take time. And I completely realize the backdrop. I think it's interesting how much put buying there is. That is a floor. At the same time, I think there's something to be said on where, what they're buying for protection. So time will tell.
Do you think that we haven't had dramatic sell-off just because people are so numb to all the headline hoopla? I mean, dude, we're on like a decade of just headline.
Well, that's always been the case, right?
I guess it's always been the case. Maybe just people have. I
I
feel
will
like we could get one more flush to the 200 day, and then that would be it. I don't know if that needs to happen on a gap. I really hope it doesn't happen on a gap.
Well, I do think that since 2013, right? So if we paint the big picture perspective, you had dot-com bust 2000, financial crisis 08, finally broke above those levels in 2013. So you had a 13-year period of sideways. There's a lot of investors that haven't experienced a protracted bear market, protracted being the key term there, months to years. And V-bottoms, buying the dip, has been the way. And it's really interesting to see retail doing what they're doing right now as if it doesn't matter. Because we never had 220-plus corrections in 3 years until COVID. We've never had 320-plus corrections in 5 years until we had inflation. Four 20-plus corrections in 7 years, the last one being the tariff tantrums last year. 4 out of 7. And every time the dip has worked, buying the dip has worked.
Yep.
And there's some concern there that recency bias is there. And so going back to your original point, are people numb that the market always comes back? And it matters when we say that. What time frame are we talking about? The market always comes back. Well, yeah, over a 150-year period, the market has always come back. But most people can't invest for 150 years, especially when you're near and in retirement. The next 10 years matter. And there's periods of time where a decade, because you brought up a decade, things have always come off of a bottom and we've moved higher. I think that's an appropriate tilt to have, but also be aware that there's 10-year periods, 2000 to 2013, early 1970s or early 1980s, where the market goes absolutely nowhere with multiple 40, 50% corrections in between. Am I calling for a 40, 50% correction? I'm not. But it is interesting to see how willing retail is to get involved. Meanwhile, institutions are selling to them. We'll see. Retail could be right. And even if this is a topping process, it's going to take a while. And even listening to us talk, like a little bit of a bearish episode here, Ian, but probably
people are going to be sad.
Probably justifiably so, below 6,800 on the S&P. A little bit problematic. But again, problematic in the near term, meaning probably some sideways still needed, sideways being a 6% range, 65.40, 200-day at 65.80. We're below 6,800. There's levels here. And what I always find interesting is the market is a measuring tool, a weighing instrument. And this range between 6,550 and 7,000 that we couldn't get over, that's a 6% range. If that range were to break to the downside, the measured move is back to the highs from early 2025, around 6,100. And that would be a 12% correction. Nothing crazy. It doesn't feel good. 12% corrections don't feel good.
Nothing that I own's ever down, just 12%.
A little more beta? It's because your time horizon is good.
That is probably something, probably my own doing sometime. All the time, right? Guess it's all the time.
Right. We can only look at ourselves in the mirror. But it makes sense. This is why technical analysis is so critical, is you have all these headlines swirling. Like, for example, let's say we rip higher from here. Let's say we clear back above 6,800 and all of a sudden we're back above 7,000. That's a thesis. Do you know how many flummoxed people there would be because of the headlines that are currently in play, especially geopolitically? Epstein lists, Venezuela, Iran, China, so much negativity out there. Oil, you brought up oil. That would really, really confuse people. And that's what markets do. They confuse people. So patience is key. You got to let some of this price discovery happen. If we are in a downtrend, where are the buyers? Well, if they're not at 6,800, are they at 6,580? Are they at 6,550? And you'll set to look at weight evidence, what's happening with, because you brought up during one of the market calls this week, the fact that energy and commodities are doing what they're doing. A lot of times that happens towards the end of a market cycle.
Yeah.
Worth paying attention to. So it's the waiting game.
Yeah, piling into energy and corn. It's not.
Corn, wheat.
We just came off a massive precious metals move, which has held up decently off the side. I mean, it's well off the highs, but in the context of the move, hasn't come cratering back down. Not yet.
And you brought up an important point that I didn't give you enough time to elaborate on. If somehow the dollar gets above 100 using DXY.
Yes, I think it's fair to say, probably since end of 2022, we've been in a dollar. I guess you could say, because dollars started getting real strong summer 2021. I'm not saying that's what led to the bear market in 2022, but certainly people spooked. I'm not saying that's what's happening again, but just saying the sell-off in stocks has coincided with a move higher in the dollar, right? And a dollar that hasn't gone anywhere since last July. So we talk about stocks haven't gone anywhere. Well, really the dollar hasn't gone anywhere since last April, but it bottomed in July. So dollar unable to move lower in July, tried it again in September, tried it again late January, not able to do it.
Yeah, and I just think the backdrop of, tariff tantrums early 2025 were supposed to be a problem. We rallied 43%. We're currently a couple percent off the highs. Consolidation is perfectly normal. You have, to your point, dollar sideways, rates sideways. It's okay if we digest this and move higher, but also need to be aware, is this distribution? And I will say, when you look at the NYAA, Dow Jones, NASDAQ, S&P, when you look at, I'm not a big volume guy, but when you look at the volume on the down days, they're bigger than the up days, AKA distribution. And if that's the case, we would have confirmation of a longer term correction if we're A, below the 200-day, B, below 65. And then the next thing you got to pay attention to is that 6,100 level on S&P 500. And then all the things that are going on underneath the surface. So we're really in that hard in between. No clear picture other than we have rising 200 days and a lot of things. Time will tell. Anything else you want to highlight for our listeners before I ask them to give a high ranking on their platform of choice?
I don't. Yeah, definitely still wait and see mode. No one wants to hear that. I don't like even saying it out loud, but that's the truth of the matter. Although, yeah, below 6,800. We start talking about a 200-day moving average. So we'll see where we close. But the dripping lower is what it is.
Makes it hard. As always, we'll remain Bayesian, wait for the new data to come in, make our decisions off of that. We've given our lines in the sand. We ask those that are listening, share it with your friends, family, repost it on your favorite social, give us a high ranking. Helps us get the word out. We really appreciate it.
Have a great weekend, everyone.